Justin, thank you very much for joining us today. How are things in California?
It's my pleasure, Jimmy. Yeah, things are good here. Thank you.
And is the state still reeling from the Republican sweep?
It's hard to say. My understanding is we're still counting votes here. So we're now a month after the election and they're still counting votes. But it is interesting to see that even California and actually every state shifted to the right. So very interesting days indeed in the U.S. Politically speaking.
Yes, and even the swing states all went Republican, which was a big surprise.
Indeed, indeed.
So I want to start right here with politics, and I want to ask you and get your thoughts on what a Republican White House means for nuclear energy in the US and by extension for the uranium price.
Sure. Well, historically speaking, Republicans have been more supportive of nuclear energy. That, of course, has been not necessarily an exception, but a welcomed addition of having Democratic support in this last administration. It would be difficult even for staunch Republicans to not acknowledge how supportive the Biden admin's Department of Energy has been of nuclear energy in the United States, whether it's the Inflation Reduction Act that had a bunch of other funding that you could argue may or may not, should or should not have been in that package, but nuclear supported funding in terms of clean energy production and clean energy investment tax credits that have been hugely beneficial to the utilities, as you can tell from the stock performance, but also very influential on the ability for the existing plants in the United States to remain profitable and remain operational and being life extended in the U.S. The addition of the Advance Act that passed a couple months back that aims to add mild reforms to the NRC and add support for advanced nuclear, whether it's the RFPs for both HALEU and low enriched uranium, the continued addition to the Strategic Uranium Reserve, pretty much across the board the Biden admin and the DOE under the Biden admin have been hugely supportive of nuclear. So, with the Republican House, Senate, and President coming into the new admin, it's generally looked at as optimistic for the continued momentum for nuclear. There's a couple of uncertainties around that. One, of course, is the IRA, which largely is supportive of climate policies and renewable energy, things that Trump notoriously is not in support of. So there's a pretty decent understanding that it's likely that the IRA will at least be chopped up. The nuclear supportive elements within the IRA are primarily supporting Republican led states in the United States. So it's difficult to see necessarily if that funding will be pulled. Hard to say. So there's a lot of uncertainty around that. Trump's nomination for Secretary of Energy with Christopher Wright, who is the CEO of a fracking company. He's also on the board of Oklo, which is a small modular reactor, advanced reactor developing company that's publicly listed. He is on record of being supportive for nuclear. Trump is supportive of nuclear. Trump also has Elon Musk seemingly in his ear on a daily basis at this point right now. It seems like it's kind of like this Batman and Robin thing going on. It's kind of strange, but Elon, of course, is additionally quite supportive of nuclear. He's made many public proclamations about nuclear should grow. We should build at least another 10 reactors in the U.S. And all of that is combined to say that it would be highly unlikely to say that Trump and Elon don't understand the enormous electricity demand growth that's happening right now in the United States, and that nuclear is an important element of meeting that demand. So we're constructive on the new administration coming in. We're just going to have to see exactly what that looks like, and that's going to take at least a few months, past the inauguration, which will happen next month. So we'll have to see exactly what that looks like. But generally speaking, there's optimism for continued momentum to support nuclear.
And yes, you brought up Elon Musk, and he's very positive or very pro-nuclear. He's got some amazing quotes, and I love the one where he said nuclear energy is underrated, and he also said anybody who considers shutting down nuclear reactors is just pure madness. But so that's what's happening, or that's what you think is going to happen in the U.S. But let's talk about Ukraine now, because Trump said within 24 hours of coming into office or coming into power, he's going to end the war in Ukraine. And He's exaggerating, of course, but let's just say it happens within 6 months. What does this mean for Russia and what they contribute to the nuclear fuel cycle? And before you answer the question, maybe you can just tell us how important Russia is to providing the various elements of the nuclear fuel cycle.
Well, Russia still is the biggest player in both the conversion and the enrichment markets. And I would argue that over the last 2.5 years, there's been a voluntary bifurcation of this market. We've seen Western utilities in the US, in the EU, and elsewhere seek out both conversion and enrichment from Western providers. Primarily, I would argue to shore up the risk that they may not receive the materials from Russia in legacy contracts, but also in support of building out those markets. So right now we have record conversion prices, right? We're looking at spot conversion trading almost at $100 a kGU, which is historic. I mean, at the bottom in 2017, 2018, we had conversion at $4 a kGU, just to give you an idea of how enormously this price has risen. So Russia is a key player, even though the West and China are building out conversion and enrichment capacity. So, for example, Orano is building out both conversion and enrichment. Urenco is building out enrichment. Westinghouse and Cameco are looking at restarting the Springfields conversion facility. There's a lot of talk around Converdyne's Metropolis facility in the United States expanding. So the fuel cycle is reacting to this pricing environment as you would expect they would and as they need to if we're going to see anything even remotely close to these growth projections that are being put out by the IAEA or being proffered by these commitments coming from the COP conferences, for example. We're going to need an enormous more amount of not only uranium mining, but fuel cycle, conversion, enrichment capacity, fabrication, et cetera. So it's good to see that slowly start to happen in response to the rising price. As far as the war in Ukraine ending, of course, knock on wood, hopefully it does as soon as possible for all involved for multiple reasons, right? How that will affect the global nuclear fuels market is more difficult to answer. The legislation that was passed in the United States, the House Bill 1042, which went into law in August of this year, that bans the importation of Russian uranium, it allows waivers, right? You can get a waiver from the Department of Energy between now and December 31 of 2027, and a few waivers have already been granted. But either way, January 1, 2028, it's over until 2040. So that is in place. That is law. That wasn't an executive order that passed the House and then passed the Senate unanimously. Democrats and Republicans all unanimously voted in the Senate to pass this bill to ban the importation of Russian uranium. So Trump can't just swipe his pen and make this go away, even if he wanted to, and we don't believe he would, because he is very cognizant of the dependence that the United States has on Russia. Why? During his first term, we had the Section 232 petition that was put forth by UR Energy and Energy Fuels that was requesting that 25% of the uranium demands for U.S. utilities would be mandated to be purchased from U.S.-based miners. And of course, in that petition, it wasn't just a, hey, help us out over here. That petition highlighted the reliance that 20% of our grid is highly reliant on Russia, our adversary. So Trump basically denied that petition, said, yeah, we're not going to do that mandating, but what we will do is establish a nuclear fuels working group to look into this problem, which he did and which they did. The results of that working group came out in 2020, the last year of his first administration. And of course, we had COVID. We had all of the mania in the United States leading up to that election, if you recall. So that kind of went on the back burner, but the results of it were, yes, this was a problem. We're going to establish a strategic uranium reserve, which he did, which continues to this day. And so he's keenly aware of this issue. And arguably, perhaps the most supportive person that could be elected into office in terms of shoring up the American sovereign energy market. So we think that it's highly, highly unlikely that the ban that was enacted here will be reversed by the Trump admin. And if it were, it would have to be done through legislation, which would have to be voted on by largely a lot of the same senators and representatives that voted to ban it in the first place would then vote to reverse it. Seems highly illogical to me. As far as the ban that just was announced about 2 weeks ago, with Russia banning the exportation of the material, which is in fact happening, the shipment that was supposed to have enriched uranium that left the port of St. Petersburg earlier this week doesn't have enriched uranium on it headed to the US. So this is actually happening. That is set to end in December 31, 2025, unless this ban gets extended. Whether or not waivers will ever be granted by the Russian entity to 10x the Russian enricher to allow those shipments to be sent out, we don't know. So that's a big uncertainty. Will that ban be part of some kind of negotiation to end the conflict? I have no idea. I have no idea. But the ban that's enacted in the US certainly is highly, highly unlikely to be reversed.
And I'm sure you speak to many utilities offline, but are they expressing any sort of concern with what Russia just did 2 weeks ago?
For sure, and you can see it. You can see the reaction in the fuel cycle and the fuel markets. Immediately, the day that was, or the day after that was announced, we saw a big jump in conversion. Like I just mentioned, that big spike. It was a $12 per kGU jump in both the bid and the ask. So immediately, if you have a shipment that's going to be interrupted of EUP, and if you can't buy the EUP at your necessary level of enrichment, you've got to buy uranium and have it converted and enriched. And that's going to send spot conversion, spot enrichment, and I believe it's going to have an effect on uranium. It's just going to be a little bit lagged. So the first effects are already being seen. And yes, of course, it's absolutely a concern whether or not a US utility would be receiving their next shipment from Russia has been the core focus of every single US utility with exposure to Russian deliveries for the last 12 months. And that continues. So this uncertainty is still there, and it's only grown. So any utility that still has exposure to Russia is doing what they can to get as much clarity as possible on the next deliveries, barring any clarity there. If they have to source elsewhere, they're going to have to do it, and they're going to have to do it in the spot market for those services and products. And it's going to cost them a lot more than what they had paid to Russia. So it's kind of a win for Russia because you could argue that it was perfectly justified for them to have a tit for tat ban. We've already banned the material, but we're saying we're banning it kind of while allowing waivers. So it's sort of lip service, although the ban is fully intact in 2028. But Russia is saying, like, all right, you can't fire me. I quit. You're not getting this material anymore. And that so far is what is happening. So still a lot of uncertainty. When there's uncertainty in the physical fuel cycle, utilities tend to step back from the table in any sort of negotiations that are happening, or if they have some uncovered needs that are, let's say, if you got uncovered uranium needs for 2026, 7, 8, usually you're going to step back on that because you need to figure out the near term towards the end of the fuel cycle, which is enrichment, and the disruption that's happening there right now. So it's causing a little bit of pause. Hopefully, there will be more uncertainty on that front in the coming months.
And I'm sure there's a lot of uncertainty too associated with Trump and his administration and what sort of policies they're going to put forth and whether or not he can resolve the situation with Russia. So a lot of these utilities might be relying on hope as a strategy.
It's definitely a poor strategy, and it's mainly a strategy that's influencing, let's say, the near to maybe the early midterm, because long term it's pretty clear. We're seeing reactors de-risked in multiple countries. The growth rate is huge. China is building 10, 11 reactors a year, and they're buying up all the uranium out of Kazakhstan. It's very obvious where this trend is going in the long term. But if you're a utility that has a delivery set for 6 months from now, and that might get interrupted, that's 100% of your focus right now. So hope does seem to be a strategy for certain utilities, not for all utilities, but some utilities are well covered and have acted in advance and have acted in response to this pricing environment that we're in right now, because the pricing environment doesn't happen in a vacuum. There's physical structural reasons for why the uranium price has gone from $18 to 80, and conversion and enrichment have tripled in the last 24 months. Like, there's reasons for that, physical reasons for that. It's not just sentiment. It's not just the financial players. All right. So that there's an actual structural physical market that is dictating this. And what we're seeing is these spikes in the services because of the disruptions, because of the much greater volume of demand that has come into the conversion and enrichment markets because the capacity in those markets hasn't fallen. In fact, the capacity has expanded during the time that the price has increased so much. What that means is that demand has increased there. And if demand has increased for conversion, you have to buy the feedstock to feed into that contract. Some of the utilities that have bought some of that conversion had some uranium on hand sufficient for those contracts. Some have not and still need to cover. That's really what we're expecting is the tail end of this. The demand hits the end of the fuel cycle first, then the front end. And uranium also is the biggest contributor to the overall fuel cost. So the overall fuel cost, uranium is 51% according to WNA of the overall fuel cost, whereas conversion is only 7%. So when conversion price triples, that matters, but it doesn't matter as much as the uranium price tripling. So when these markets get disrupted through increased demand and the price rises, you're going to go ahead and get what you need to get at whatever price you need to pay for conversion and for enrichment. Then you come back to the uranium market, and hopefully the price is at a price that is reasonable for you. And the utilities are not happy with the pricing environment right now. And especially look at what happened and came out today. NextGen, who's developing the largest undeveloped uranium deposit in the world, Arrow in Saskatchewan, announced that they have signed contracts with multiple large utilities in the US. And these contracts are for 2029 to 2033 delivery with $150 ceilings escalated. So this is, as far as anybody's heard, $20 or $30 on the ceiling, higher than the last we've heard, which was from Cameco's conference call last month. So to consider that an undeveloped project, usually undeveloped projects are signing fixed price contracts or majority fixed price contracts at prices that are in the ballpark of where uranium is trading right now. So what are we, 82, 83 long term? Spot is 77.50, 78. And they're signing $75 floors, $150 ceilings. That is a huge signal. Not only that they negotiated to disclose the terms of these contracts publicly, which doesn't always happen, but also that the ceiling is so much higher. It's clear evidence of where this market is going.
But I would argue $150 5 years out is not very high. It's not a high price, like
It's the
especially given
highest that
the
we've heard.
positive backdrop.
It's the highest that we've heard. So contracts, when you're signing contracts into the future, you're always signing contracts that somehow will benefit the producer, but also protect the buyer. And the terms of those contracts start to dictate exactly where the market thinks it will be going, right? And so this is a seller's market. If it's a buyer's market, you're going to see contracts right around the price of the existing where it's trading now. Or if there's bearish sentiment going out in the future, you're going to see contracts at lower prices. So when we had the price starting to slide following Fukushima, Japan shutting down all their reactors, you had long-term contracts being signed by Orano and Uranium One and Kazatomprom at lower prices than the existing market because that was the understanding is that we're in a protracted long-term bear market here. Now that has shifted. So to be trading at $78 spot, 82 term, and to have a ceiling go from the 120s, 130s that were just here about a couple months back to 150 for an undeveloped project is a significantly, incredibly bullish signal. So this is not saying that NextGen doesn't believe the price might be higher. For NextGen to sign contracts reference to the market and for a utility to agree to a ceiling at double the price is significant. I'll tell you why, Jimmy. If you look at the actual polling that like UXC would do with utilities, they do these surveys twice a year. The utilities almost always and almost universally believe that the price 5 years from now will be what it is now. And if you go back and look at these surveys last year, the year before, I mean, since we've subscribed to UXC service and we've been looking at the survey results, every single year they do these surveys, the utilities just believe that the price is going to be where it's at now, years from now. And there's no reason for them to believe otherwise. It's not their job to predict the pricing. So to have a project that hasn't even had a shovel hit the ground sign a market reference contract at double the existing prices is incredibly, incredibly bullish, and basically is telling everyone Buyers and sellers expect the price to go here because what the ceiling is doing is protecting the buyer. The buyer agreeing to a $150 ceiling is full well believing that the price could be way, way higher than that, and they want some protection to the upside.
When you were talking about the polling that UXC does, I was wondering if they also do the polling for the US election, right? Because they were so wrong. And it just makes you think that there's got to be a better way to find out what people are thinking.
Well, the polling is voluntary, and out of the multiple utilities that are requested to poll, only a handful of them actually end up answering. So I think usually there's between 15 or 20 utilities in the U.S. that respond to these, and a few outside the U.S. to these surveys, but they're anonymous. The polling is anonymous. So, and it's basically a sentiment check, right? And where the price will be in 5 years is only one of the multiple questions. So there's one of the questions will be, is the current price high enough to incentivize undeveloped projects to bring new supply online? And the utilities always say yes, largely. There's always a couple of outliers, and I usually know who those outliers are. The forward-thinking utilities will typically generally be more aligned with, let's say, the investor outlook. So if you look at, what we're putting out there, if you look at what Canaccord is putting out there, if you look at what RBC, they just did a report a couple weeks back, incredibly, incredibly bullish, where they're seeing much, much higher prices going out into the future. And anybody that's actually modeled out supply and demand has a totally different expectation for the coming years than a utility does, because the utilities experience, and to their credit, they've generally been right. If you've been in this industry for 20, 30, 40 years, every time there's been a huge price rise, if you just sat back for 12 months or 18 months, you were right in thinking that the price came back down. Now, the exception might have been '04 to '06 or '05 to '07, right? That kept flying, especially with the spot price. But with these tiny exceptions of big price spikes, if you just waited it out, the price came back down. And that guaranteed is sentiment amongst a lot of utilities right now. This is why we're still seeing relatively tepid volumes being secured in the long-term contracting market. They're going after enrichment, they're going after conversion, they're drawing down some inventories. Meanwhile, China is buying like crazy at these prices. We're going to see the utilities step in a bigger way into the term contracting market because they have to. There's no other alternative to buying uranium. If you can buy EUP, if you can buy UF6, then you're going to do it, and they already have. Now, those markets are already constrained. Now they have to buy uranium to feed into those contracts.
So yeah, I understand all that, but I'm only going to ask you about the long-term market because Grant Isaac always says the spot market is not the real market. So this year we are at 91 million pounds that have been contracted in the long-term market, and versus I think 160 million pounds last year. That's a big difference. And you got to think with this bullish sentiment and this bullish narrative that there would be a lot more pounds contracted. Is that because there's no pounds out there for utilities to buy in the long-term contracting market?
It depends on the time frames. So if you ask Cameco or Kazatomprom or Orano if you want to sign a contract for £1 million per year delivery starting in 2026, they're going to tell you you're going to have to go elsewhere. So, in the next few years, there's very little uranium available from the existing producers. And the development projects, they're not coming online that time frame anyway. So the market is tight in the near term across the board, not just for uranium, for every element of the fuel cycle. You go out in the late decade in the 2030s, there's uranium available. So the reason I believe that the contracting market has been such tepid in terms of its volume this year is largely in response to two big factors. One, the biggest market in the world being the United States having major disruptions with the fuel cycle, with the banning of the importation of Russian uranium. So that causes utilities to focus on the problem, which is, are we getting our next shipment or not? And step back with uncertainty, right? And that's the biggest market in the world, in the US. The Europeans have been contracting a heck of a lot more than the US utilities. Okay. So the other reason is that the price doubled last year. And the price in the term market, the price is up 20% this year alone. So for the price to go in the spot market from 50 to 106 and back down to the high 70s, that's a much, much higher low in this series of higher highs, higher lows that we've been in for the last 4 years. So usually what happens in these types of markets is you have this big buying spree that we had in Q4 of last year, where multiple players were involved. Utilities, producers, traders, and financials were all buying uranium Q4 of last year. That pushed the price up. The term price kept chugging higher. Utilities said, okay, that got out of hand pretty quick. Let's take a breather. Let's draw on our inventories a little. Let's buy a little bit of what we can in the farther end of the fuel cycle. Let's sit back and see where uranium settles out. Well, this is where it settles out. And we know it settles out here because the volumes are not pushing it higher. The volume's been low enough to allow the spot price to settle up. Meanwhile, the term price just keeps stair-stepping higher. So that's why we think it's been quiet, relatively quiet in the term market. Chinese, that's a different story. Those numbers I don't think have hit the reporting yet. But we're going to probably see. I mean, this is a decent call because we got 3 weeks left before the month end reporting from UXC, but we'll probably see some more pounds added based on those Chinese contracts. Not positive on that because like I said, the reporting is voluntary. But I think next year we see much, much higher volume being done in the term market because now the industry can see where the price is settled out. And hopefully within the first quarter of next year, we'll have some clarity on Trump admin's policies in the United States for nuclear, whether or not the funding from the IRA for clean energy production and investment tax credits, if those remain in place, or if there's additional supportive measures from the Trump admin for the nuclear utilities in the US, we're going to see them step back into the table in a big way. And either way, like I said, the Chinese just aren't slowing down. So the big demand influx into the conversion enrichment market, that's going to lead to the uranium market hitting much, much higher volumes. And keep in mind, the burn rate globally right now is 185, 190 million pounds a year. So to see a single replacement rate year of contracting, we're going to see the price get pushed a lot higher because of how tight the market is.
And I'm sorry, you said the term price is up 20% on the year?
Yes.
And so it's around $80 a pound.
82, 83.
And, once again, I don't mean to beat a dead horse, but when I look at this sector, there's so many positives, right? And you've already listed a few of them, but we didn't even talk about China. They're building out 30 reactors. They have 30 reactors under construction right now. That's going to require a lot of uranium. The data centers, you touched on this, but right now, data centers in the US consume 3% of electricity, and that's going to triple within the next 5 years. And of course, we have Amazon, Google, and Meta all going after nuclear energy. Meta actually has an RFP out there. They're trying to acquire some pounds. And how many mines? There's so many mines that are trying to start up. They all have production problems or startup issues. And then we have the issues going on in Niger. Those are lost pounds, and Nigeria is a top 5 producer. Then we have the issues going on in Russia. Who knows what's going to happen there? But when I look at all these different elements, I still ask myself or wonder why term and spot are not significantly higher. And even when you look at the all-time price of uranium, 140 or 150 bucks, inflation adjusted, that's over 200. And then you just made mention of the fact that NextGen just signed a ceiling for $150 a pound, which seems extremely low to me when you're looking 5 years out. Like, I don't know. I just wonder if with all this positive backdrop, like, do we not see a doubling or a tripling of the uranium price in the next couple of years?
Oh, I think that's highly likely. I think that's highly likely. You have to understand that the contracts, again, they're not trying to grasp every single ounce of upside that they possibly can. And it's also speculation 5 years away, or 2033, 8 years away. Nobody knows what's going to happen between now and then. So if you can secure a contract with floors right around these prices, when your cash costs are going to be 15 bucks a pound and your floor is at 75, 80, with the ceiling of 150, that's enormously profitable. And this is also a development project that the shovel hasn't even hit the ground yet. So to have contracts like this, especially disclosed publicly, in my estimation, is an enormously bullish signal, right? You also have to look at the spot price spike that happened in 07 was driven almost entirely by financial speculators, by hedge funds. So that, yes, there were utilities that did sign contracts north of $100 a pound, and all of them will never live that down, right? Because the price came crashing right back down with the GFC, followed a few years later, 4 years later by Fukushima. So you signed a contract at $100 a pound for delivery in 07 for delivery in 2012. You were in a world of hurt. And so utilities remember that. The fuel buyers, those fuel buyers that did that, they're still working for the utilities right now. And they all remember that. So you have a lot of recency bias in the industry. You have a lot of opposition in the industry to the current pricing environment. I mean, imagine if you're a utility setting up to the table, talking with NextGen about signing contracts for delivery starting in 5 years, and you've seen NextGen's feasibility study. All right, it's public information. You're a fuel buyer. You're sitting at the table. Let's say you've got their feasibility study open that's showing that their cash cost is $13 a pound or whatever it was, something in that ballpark. And they're telling you we want $80 floors or $75 floors. I mean, how does that make you feel as a fuel buyer? Saying, okay, you guys are going to repay your debt you're going to take on to build this project in less than a year, and then you're going to be swimming in profit. Why is that fair for me? So just imagine the negotiating discussion that would happen between a utility looking at a project with very, very low operation production costs, yet you're signing a contract with the ceiling at 150 escalated. So by the way, 150 escalated is not 150 in 2033. It's 175, 180, whatever it might be. These are the highest contract terms that we've ever heard in the industry's history. So this is not a bearish signal, even though investors want to see an inflation adjusted spike to $500 a pound. They want it to happen tomorrow. The industry doesn't move like that. The industry moves in fits and starts, and it moves in very, very long-term cycles. And we continue to move from the lower left to the upper right across the fuel cycle. And right now is no exception. All that's happened this year is that term has continued to move higher to a more than a decade high price, and the spot price has consolidated downward to a much higher low. This is absolutely perfectly healthy from a technical perspective. And to see these levels of ceilings being negotiated for an undeveloped project for delivery just 5 years from now is enormously, enormously bullish.
And there's probably a very good probability that they're not, that mine is not even up and running in 5 years.
Probably a high probability that that's correct.
So, two questions. What was the all-time high in the term market?
The all-time high in the term market, I believe, was pushing about $100 a pound when spot price peaked out at 134 in 07.
Okay.
Didn't stay there very.
And why did NextGen make this information public in terms of their floors and ceilings?
Why indeed? Well, I mean, this ceiling is like I said, it's 20 or $30 higher than the last ceiling that was publicly disclosed by a producing company, Cameco, right? In their conference call last month, Grant Isaac mentioned ceilings in the 120s, 130s. So for NextGen to come out and say this, and by the way, the ability to disclose these terms is part of the negotiation, right? That's a seller's market, because I guarantee you the utilities that paid this, they didn't want this to be disclosed. Ideally speaking, utilities don't want this to be disclosed at all. They want this market to be as opaque as possible, because all of a sudden, if multiple large US utilities sign contracts at the $150 ceilings with an undeveloped project, that means that's a signal to all of the other utilities that have yet to step up to the table that that is on the table as a possible ceiling that they're going to have to agree with. And this project is also really important because multiple utilities have told me that they are expecting supply influx in the later part of the decade coming from projects like NextGen's Arrow to be kind of the savior, right? So there's utilities, and this is going to sound crazy, but I know for a fact there are utilities that are still on the sidelines with contracting with any of the reliable producers like Cameco or Orano or Kazatomprom, whoever it might be, right now at these terms because they believe one of a few things. They believe that Kazatomprom is going to be able to ramp to 80 million pounds within 24 months. They believe that Sput is going to somehow, the pounds held by Sput are going to somehow trickle into the market, which they're not. They believe that next gen's arrow is going to be this massive windfall of supply that's going to crush the uranium price. And so you can, anybody who's done 10 minutes of work on the sector understands that those are foolish beliefs. But this is the way that some of the utilities think. So for NextGen to be able to disclose publicly the terms of this contract, that is an enormous amount of leverage for them and all other producers or developers to bring to the table for the next round of higher volume contracts to be signed. So it is an absolute boon for the company to be able to disclose this publicly. And it also is going to continue to support the upward trend of the term price and ideally the spot price as well.
I want to ask you about the equities now, and because one of the things I find somewhat confounding is we've seen these massive moves in some of these U.S. utilities. Constellation Energy, for example, it's up over 100%. And then when you look at Cameco, it's up 40 or 50%, which is not too shabby, I guess. But there's a lot of other stocks who are not performing as well. And it looks like a lot of the money, maybe the big institutional money or the hedge fund money, is flowing into these utilities. Do you think that's what's happening? Is there just more liquid names, or what are your thoughts?
I think it's liquidity. It's also that these utility stocks have been held in some of these newer ETFs, like Nukes, holds a lot of these utility stocks. It's a matter of liquidity. If you look at the liquidity of even Cameco pales in comparison to Vistra or Constellation. And these have also been enormous beneficiaries of the deals with the tech companies. So like Constellation's deal with Microsoft and with the power purchase agreement for 20 years at way higher electricity prices. There's an assumption that's going to be beneficial to the utility, which I'm sure that it will. And also the funding in the IRA has been hugely beneficial theoretically and in practice thus far for the nuclear utilities. So I think a lot of what is priced into the utility stocks has to do with assumptions around the IRA. So that could be disrupted going forward. Possibly, I'm not sure. Hopefully not, because I ideally would like to see these utility stocks, utility companies continue to grow and to benefit from this influx of capital and support from the Biden admin. Why? Because that means de-risking of their fleets. And we want to see the US fleet stay on. It's going to stay online. It has to stay online because the prices are going to be there. And we can't shut these things down right now. It's just the electricity demand is too great and the AI race with China is too important. And I believe that the Trump admin and his cohort fully understand this and are going to make sure that that's the case. But as far as comparing uranium to other sectors, there's always a bull market somewhere. There's always a feeling of FOMO. There's always a feeling of opportunity cost. This is why it's important to diversify. This is why, however bullish you are in any sector, it's important to not put all of your money and all of your eggs into that one basket. Looking at the utilities, looking at the uranium equities right now, they're up pretty decently lately, which is really good to see, right? So the spot price, for example, which is arguably less important to the industry than the term price based on the volumes that are actually procured by end users, not traded volume. But the spot price is the most visible metric that's reported. So that's what the investors watch. So the spot price from early September to now is actually down, I think, $1. Yet the equities are up 30%, 40% from that point in time. So charting the equities against the spot price basically looks like a big double bottom, starting to look technically better. Would love to see that outperformance continue. We'll have to see how that goes because I think the spot price is going to go as well. I believe over a multi-year time frame that the equities could literally trade horizontal against the spot price, and we're going to be very happy campers because I think that the spot price trend is going to continue. I don't see any evidence as to why that would not be the case. There's no surprise influx of supply happening. There's nothing on the horizon, and every other element of the fuel cycle continues to move up. So we think this consolidation is close to its end point, and another leg higher is coming for uranium, which should bode well for the equities.
And we are only a few weeks away from 2025. What should investors look out for as we go into 2025? And do you expect any big announcements in terms of contracting?
Hard to say between now and the next 3 weeks in terms of announcements. Usually the industry kind of goes to sleep, especially the last 2 weeks of the year. There's a little bit of dividend selling pressure that's probably going to come in. It doesn't look like it's going to be huge, but it's going to be something but that didn't really affect things more than a couple of days last year. And I think it was larger last year as well. So we should see kind of a probably quiet end of the year and for the uranium equities. Plenty of them are up year to date. Plenty of them are flat. Some are slightly down. Shouldn't be a lot of tax loss selling happening in terms of pressure on the sector. Moving into the new year, I think once we have more clarity around the Trump administration, what they plan to do for nuclear in the US is going to dictate in many ways how the US utilities act going forward. So there's still a little bit of a waiting game, but I think we're counting the weeks before we start to see pressure and higher volumes come into the spot market. And honestly, I'd love to say, everybody should just ignore the spot market, but the spot market is what is visible. And I think the spot price and the term price, but especially the spot price, this is kind of the last shoe to drop here. There's this story is so much more broad now than it was even a couple of short months ago. There's new investor interest institutionally that have come into the sector based on the tech support and the big stories that have come out. So everybody gets it. Nuclear is a growth story. Big tech is here and they want to get it done, and they will get it done. Life extensions almost entirely across the board. The possibility of restarts in Germany, not holding my breath, but it's certainly possible. The story is so good on so many fronts. I don't need to repeat it ad nauseum. The last shoe to drop here is for the uranium price to continue its uptrend. When it does, I expect the capital inflows to be very, very large. And I expect that to happen. Like I said, I feel like we're counting the weeks here before we see the next leg to start in the spot price.
Well, if anyone can get it done, it's Elon Musk.
It's true.
And I hope to see some Bitcoin-like moves in 2025. Well, Justin, that was a great discussion. I want to thank you very much for spending time with us today. If somebody would like to learn more about you and your various services, where can they go?
Thanks, Jimmy. I appreciate you having me on. Uraniuminsider.com is our website. I also have a decent presence on X at Uranium Insider.
I will make sure I include a link in the show notes below. Once again, Justin, thank you.
My pleasure.